Hi, I'm Ruban Selvanayagam from Property Solvers Auctions. One of the most common questions we get asked by prospective bidders is whether it's possible to buy an auction property with a mortgage. We most commonly respond with a no, because whilst it's theoretically possible to use a mortgage to buy an auction property, the reality is that traditional auctions and mainstream mortgage finance don't particularly work well together. In fact, after more than 20 years in the property sector, I go as far as saying that the most experienced auction buyers would never rely on a standard mortgage at the point of purchase. So in this video, I want to explain why that is, how professional investors typically finance auction purchases, and how many buyers ultimately transition onto a mortgage once the property meets mainstream lending criteria. Let's get into it. The first thing to understand is how a traditional auction actually works. At a standard or unconditional auction, exchange of contracts takes place immediately when the auction closes successfully. The buyer pays a 10% deposit and becomes legally committed to completing the purchase, typically within 28 days. From a seller's perspective, that's one of the biggest attractions of a traditional auction. The buyer's funding is already arranged before they bid, which is one of the reasons auction completion rates are so much higher compared to the open market. And from a buyer's perspective, understanding how you're going to fund the purchase before bidding is absolutely critical. The problem is that mortgage lenders operate on very different timescales. Before releasing funds, lenders usually need to carry out valuation checks, detailed underwriting, affordability assessments, legal due diligence, and a range of other internal checks. And whilst every lender is different, that process often takes considerably longer than 28 days. So the issue isn't whether you can get a mortgage, it's whether you can get it approved, underwritten, legally checked, and completed within the auction deadline. For most buyers, that makes using a mortgage in addition to the deposit practically impossible. It's also worth remembering that a mortgage in principle or decision in principle isn't a guarantee that the lender will underwrite the loan and ultimately lend against the property. Survey results can change things, valuations can come in lower than expected, underwriters can raise concerns, and lender criteria can change. If you've already exchanged contracts at auction and the lender subsequently reduces or withdraws the offer, you're still legally obliged to complete. And that's a risk that many first-time auction buyers in particular underestimate. There's also another issue that regularly catches people out. Many auction properties are being sold precisely because they don't fit neatly within mainstream lending criteria. They often require significant refurbishment, suffer from structural defects, have short leases, title complications, non-standard construction, or a range of other issues that lenders simply don't like. In some cases, the very reason the property is attractive to an auction investor is the same reason the bank won't lend against it. So how do experienced auction buyers finance these deals? In most cases, they buy first and mortgage later. The purchase is usually completed using cash, bridging finance, or other forms of short-term funding. The buyer then resolves whatever issue prevented the property from being mortgageable in the first place. That might involve refurbishment works, lease extensions, title rectification, planning or building regulation issues, or simply bringing the property up to a standard acceptable to lenders. Once the property becomes mortgageable, it can then be refinanced onto a longer-term buy-to-let or residential mortgage at a much lower cost. This is often referred to as the BRRR strategy, buy, refurbish, refinance and rent, and it's a common approach used by professional auction investors throughout the UK. It's also one of the reasons sellers often favour experienced auction buyers. Cash and bridging funding purchases can usually work with auction deadlines far more comfortably than buyers relying on mainstream mortgage underwriting. Now, it's also worth mentioning another auction format that works much more comfortably with mortgage finance, the modern method of auction. Unlike a traditional auction, the buyer doesn't exchange contracts immediately when the bidding finishes. Instead, they pay a reservation fee and are normally given around 56 days to exchange and complete. That additional time allows for mortgage valuations, underwriting, and conveyancing to take place properly. This is one of the reasons modern method auctions have grown significantly over the last 15 years or so. They open the process up to owner-occupiers, first-time buyers, and standard mortgage applicants who would otherwise struggle to participate in a traditional auction. Of course, the trade-off is that modern method doesn't provide quite the same level of legal certainty as a traditional auction, where exchange happens immediately. But for many mortgage buyers, it's a far more practical route. So when can a mortgage work for an auction property? Generally speaking, when the property is already mortgageable, the legal position is straightforward, the condition is good, and sufficient time exists for the lender to complete their checks. For traditional auctions, however, as a buyer, you should be extremely cautious about relying solely on mortgage finance, unless every element has been lined up well in advance, which of course comes with its own costs and risks. Because once contracts have exchanged, the legal commitment is very real, and missing the completion deadline can be a very expensive mistake. So, to draw this video to a close, can you get a mortgage on an auction property? The short answer is no, because if you're bidding at a traditional 28-day auction, depending solely on a standard mortgage can be extremely risky. That's why most experienced auction buyers either have the cash available, arrange bridging finance in advance, or only bid on modern method auction properties where the timetable is much more mortgage friendly. Now, in practice, some buyers may approach us and other auctioneers to request an extension to complete and therefore organise mortgage finance, particularly if they perceive that a property hasn't attracted significant interest or it hasn't sold at all. In certain cases, sellers may agree rather than remarket the property. However, it's important to not rely on that outcome. Auction is built around fixed timescales and contractual commitment, and any extension remains entirely at the seller's discretion. Indeed, the most successful auction buyers and investors don't think about finance after they've won the property. They have their funding structure and exit strategy in place before the auction even begins. If you'd like a straightforward conversation about auction finance, buying at auction, or whether you have a property for sale, feel free to get in touch with the team here at Property Solvers Auctions. And if you found this video useful, please like the video and subscribe to the channel. Thanks very much for watching.